Hello, everybody. Welcome back to another episode of The Designated Designer, a podcast about design where curiosity is the compass, creativity lights the way, and transformation is just part of the trip. I'm your host, Jennifer Stank, your brand spirit guide for this wild, wonderful ride where we navigate our creative existence in today's modern and conventional world. Today, I am joined with a very special guest, a fellow member of my local BNI chapter, so shout out to Business Networking International, Jim Gillespie of Nexa Mortgage. So this is going to be a little bit of a different episode, guys. This is not a designer to designer episode. I actually have somebody that specializes in finance and lending and mortgages. So all of you fellow business owners out there, you're going to want to tune in because Jim has a lot of amazing knowledge and wonderful experience to share with us today. So without further ado, Jim, do you want to give us a little bit of an introduction as to who you are, what you do, and why you do it?
Thanks, Jen. This is exciting. I always grew up a numbers guy, and 2008, I was in a completely different career. When the market crashed, my job went away, and I needed to find a new job, and the only places hiring was in mortgage lending, and I didn't know anything really about it. But I was always a numbers guy. I decided I would take a shot at it, and then I kind of realized that like the market crash in 2008 was because of mortgage people and the loans and the bad lending that was out there. I got in it during the transformation of things when rules got put in place and standards got raised as to who was allowed to give mortgages, who was going to get approved, and how we were going to reshape the housing market for our future. And that was, I think I got to learn my career at the best time, which is when it was at its lowest. And that was 17 years ago now. It's really tough now too, but I'm well versed and I try to help people every day.
That's awesome. Did you want to talk a little bit specifically, because I know we chatted beforehand and you have a lot of really awesome knowledge. Did you want to talk a little bit about some of the things you were kind of seeing in the market back in 2008 and what you kind of pieced together as to why everything kind of happened the way that it happened and how you kind of moved forward from all of that? So
when I started, there was no formal training and there was no textbook for how mortgages would be given out and stuff, and people getting qualified and approved. And then in spring 2009, the Dodd-Frank Act got enacted. What it did is that it reshaped and added rules and regulations for mortgages, for lending in general. It established the CFPB, the Consumer Financial Protection Bureau, because there was predatory lending going on all over the place, which was essentially where consumers didn't know what they were getting themselves into. They didn't know how bad the loans would be for them in repayment. And the term ability to repay became the slogan and what everything is based on. Moving forward, back then and into today, we've established certain criteria of your debt versus the income that you bring in monthly, certain guidelines of maximum allowable debt when you include what you pay in your housing plus the debts that are on your credit report, so that you're not overextended and that you can pay back your creditors and still have money to eat and live. Where back then they really didn't care. They just wanted to lend, and quality of life wasn't their concern. Again, I don't know how anybody rationally could have said that this was a good idea when they were in the middle of when they were doing it. But it crashed it reset our entire financial system. And rules and regulations were needed, have been needed, will forever be needed, because without them, greed takes over.
How did you kind of see the market bounce back from everything? Once all of that, I know you mentioned about predatory lending and there were some bad practices going on, and a lot of brilliant people kind of put their minds together to enact this and kind of get everything back on track. How did you see that kind of play into everything?
Well, again, 2000 being in the business, 2009, 10, and 11 were really hard. It was really hard because it established a lot of standards that were never in place. There were never standards for, even like the way that closings went and the way that the preparation for closing went, and timelines on people ordering moving trucks. Like sometimes, like people were or like the amount of times that people would have moving trucks on the day that they were supposed to close and it never closed, and then I mean, it was shambles. But they thought of everything, and got to give Elizabeth Warren as much credit as possible. She was most of the architect of the Dodd-Frank Act in establishing consumer protections. But I saw it where it went from people buying with 100% financing where they had nothing invested. So if they got foreclosed on, they weren't really losing like money back then. You saw people that, because of the foreclosures and all that, whatever house they bought, their value wasn't as much as they owed, and they were underwater. And we saw there were a lot of programs during that time that helped people get out of those situations into better terms of their mortgage, so that the repayment would be easier. I mean, it was a lot of stuff on like until we kind of normalized in, like, I want to say 2013, 2014, where people started to really understand how to get approved. Once all that happened and that whole transition, it was tough. But now there's standards for how people get approved, how first-time homebuyers incentives. We had the first-time homebuyer boom, I'm going to say 2013 through 2020, because values were still recovering from the crash, and rates were stabilized in the 4 to 5% range. And then the pandemic hit, and the best and worst thing that ever happened to the housing market was that we had low rates. The existing homeowners were able to refinance into rates in the low 2s to low 3s. And I mean, it's almost free money in the financial world that they were borrowing. But it set the housing market back, I'm going to say 10 years, because the lower the monthly payment, the higher demand. It artificially shot values up. A house in 2018 that was $250,000 is a $500,000-$600,000 house now, without changing the quality of the home.
I never even really thought about that. First of all, we are creatives. I know that I mentioned this to you when we had our quick chat yesterday, but we really don't understand a lot about, I speak for myself, most creatives kind of fall in the same category. Some are like superhuman and they can do everything, but for most creatives, numbers are not our strong suit. And especially when it comes to the whole like housing, mortgage, assets, liabilities, debt to income ratio, like everything that you kind of touch on, I think is so fascinating and interesting, because we really don't have our minds geared that way.
To your exact point, not in middle school, not in high school, not in college, have we ever been taught how to buy a house? Personal finance was an elective in college, but it's not really taught. Like, you might have 2 months of high school algebra about like personal finance, and everything else you learn on the run. And there's been so much change since 2009 in whether it's, again, the established rules and regulations, or just the evolution of banking. And I mean, I'm dating myself, but like, I remember when ATMs came out. Like, there was never ATMs, to now you take a picture of your check and it gets deposited. Different world, evolution, digital banking. Until 2018 in the business, we never had online applications. Everything was paper. If we had a scanner, we were ahead of the times. I feel like that's a badge of honor, because I've seen the evolution, and now AI is going to do a lot of the back office work. But there's verifications now that, like, bringing your bank statements, click of the button and they're verified online. That whole first time home buyer 2013 and 2020, three or four times a day, I was just teaching people how to buy a house. And I mean, just for your listeners and for everybody, the last 2 years is really all that matters. It's a 2-year living history, work history, credit history, debt, and assets. Everybody gets paid differently. I mean, it's wild. I don't think that the general public even realizes how different everybody gets paid, whether like it's hourly at 40 hours, hourly at 37 and a half, commission based, bonus and commission, self-employed, and the millions of different ways of self-employed.
Does that have any effect from what you see as to like getting pre-approvals, like the different types of pay structure? Is it looked at differently? Like, are certain pay structures discriminated against, for lack of a better term?
I'm going to say that accountants work against us. Your accountant wants to have you pay the least amount of taxes possible. Approval purposes, we can only use taxable income.
Oh, I had no idea that that's a thing.
So
that's interesting.
Because everything's about ability to repay. Ring in your head, ability to repay, because that's the theme for finance in life. Whether you're buying a house, a car, a motorcycle, a boat, anything, everything's about when they pull your credit and they get your income. They look at your debt to income, and if you're overextended, that you won't be able to make your loan payment back. And I can't tell you how many self-employed people, I make $300,000. Okay, but you show 28,000. I have to base it off 28,000. Well, no, I make 300. Well, show me. Well, I don't want to pay taxes on it. Okay. Like,
I could see how that quickly becomes a slippery slope.
Absolutely.
Absolutely. I'm so glad that you brought that up, because my audience is primarily business owners, and a lot of us are probably within that age range, starting to settle down, starting to start families, and eventually hope to buy a house. And I think for a lot of listeners, it is so gray. Like, most of us know nothing about what it looks like to try to buy a house, what it looks like to try to be approved for a mortgage as a business owner income, and some of the things that go along with that, you know, kind of like you were saying about the taxes. Of course, everybody wants to get the most amount of tax deductible items at the end of the year. But if you're in that process of trying to purchase a house, maybe you don't put the laptop on as a tax deductible thing, or, you know, maybe you kind of watch those numbers just a little bit better to better gear yourself for the next step. I'm really glad you brought that up.
So let me add to that. There are alternative programs. There is a business bank statement program where what they do is they take 12 months bank statements, 24 months bank statements, depending on the program, and they will average your deposits and take, let's just say, a 50% liability expense. So 50%, sometimes it's 40%, but we'll say 50% of whatever goes in, they'll use as your monthly income and qualify based on that income. The thing about that, there are no special programs for that. There's what's called a QM and a non-QM. QM is a qualified mortgage. Qualified mortgage is when your tax returns or your W-2s or your pay stubs establish your income and that we can get you approved on that. A non-QM is non-qualified mortgage, which is just an alternative income, which is, like I said, you're like you get money as a self-employed person, and you make a lot more than what shows in your tax returns. But we can show that as the money coming into your business. We know that you have money to pay bills, but it just doesn't reflect on your tax returns.
Right.
But to that point, those loans are considered more high risk. There's a higher down payment and a little higher rate. But the rate differential has gotten a lot better now, because we're a few years into having those type of loans and those type of situations than we were when they first came out 7-8 years ago.
That's really, really insightful stuff. So do you want to pivot just a little bit to general finance as a whole, and kind of like tell me a little bit about the customers that you like to work with, in case anybody out there listening, you know, is looking to get some kind of lending done?
Average age of buyers in 2018 was like 29 and a half years old. Average age of buyers in 2025 is 56.2. 6-year difference.
What?
And that's because, like I brought up earlier about the values, a $250,000 house is now $500,000. Rates were 3%. Now they're 6.5%. The affordability is a lot higher now and a lot harder. And until we have a huge reset financially, I don't see it changing anytime soon. But to that point, if I have to give any tips to people that are coming up trying to build their credit, build their financial profile, because an approval is based on what your profile looks for that day of approval. After closing, you can do whatever you want, but pay your bills. But you don't have to have all the money in the bank. You don't have to this, that, and the other. But for that one day, we have to get your financial profile to an approvable status. Credit matters. I don't care if you have to beg, borrow, and steal. Make your minimum payments on your credit cards. Don't default on the stuff that's on your credit report. It doesn't come off for 7 years. Credit is key, like in approvals and the benefits of other programs that are incentivizing buyers. Like I'm not just rates themselves, but like there are down payment assistance programs, there are closing cost assistance programs when you're buying a house. I mean, there are a lot of things that if you get in those programs, you're going to get better terms. You're going to make it easier on yourself to buy. Do not use credit counseling. Call me. I can be a free credit counselor for people, because back in that 2013 to 2020 range, there were people that built a whole businesses on credit counseling, and I mean they're essentially just looking at a credit report and telling people what to do, and or they're sending in letters to challenge a delinquency or a charge off or a collection that's on someone's credit report, but they're charging people excessive amounts of money for stuff that can all be done for free. And I've seen a lot of people spend a lot of money to get nothing out of it. With my experience, I know what needs to be done to get people approvable. You might have 7 accounts, but I have a credit analyzer that we can target 1 or 2 accounts that if you improve these accounts, your score goes up 40, 50 points.
So talk to me a little bit about credit score, because this is something that I know nothing about. I know when we briefly spoke, I filled you in, and most of my audience already knows that when I started my business, I did not know how to pay a credit card. I didn't know how to write a check. I didn't know how to open a banking account. So all of this stuff came to me really late in life, whereas a lot of people do kind of have experience with this stuff earlier on, but some of us don't. And
No,
I honestly
right.
have no idea about like credit score. What are things that affect credit score? What are things that can help improve it? Like, can you just give us a brief overview of what that looks like?
So your credit score is composed of your credit payment history, percentage of money percentage of usage on your credit cards, age of credit cards, age of accounts, types of accounts, whether it's unsecured, which is a credit card, secured, which is a mortgage, a car loan, student loan, or like a payday loan, which is a personal unsecured loan. There's algorithms that will determine how they score it. Experian, TransUnion, and Equifax are the 3 bureaus that matter. They each have a different scoring system, and they won't tell you what it is. That's why you have 3 different scores if you had the same accounts. They're going to be similar, but never the same. That said, depending on, sometimes you might have an account that's like, I don't know, like an Affirm. Are you familiar with Affirm?
See, that's actually what I wanted to ask you about, because I know nothing about credit score, and when I was checking in on it, I checked on my credit score and it was 820. And that was after I had an Affirm for my laptop, which I always made my payment on time. And then after that Affirm was done, I don't have any other outstanding loans. And I noticed after about 6 months, my credit score then dropped to 804. And when I went into the little like thing where it might say why, it said because I didn't have a loan taken out in a certain period of time. And I didn't know what that meant. So definitely tell me a little bit more about Affirm.
So never cancel a credit card. Never close a credit card, because people are going to get false information that a credit inquiry really matters. It doesn't really matter. I mean, what matters is 95% of your score is going to be about your payment history. That's why I said always make your minimum payments on whatever it is. Even make partial payments if you can't make if you can't make the full payment, because if you make an effort to pay something, they can't mark you late, and you have a 30-day window from the date of the due date until the next due date, where if you pay during that 30 days, you are not 30 days late. You do not get marked on your credit report.
I didn't know that.
So like you'll always see when you do get a mortgage, you'll see that the mortgage due date is always the first of the month. You have a grace period of the 1st to the 15th where you have no penalty. Between the 16th and the last day of the month, they charge a 5% penalty. But if you pay even on the 30th day, like October 30th, your October mortgage is not late.
Wow. So I could see how that could be beneficial then.
Absolutely. Like, listen, everybody's going to have ups and downs on their income and on their like job and things. Know when your due dates are. Make a plan. Have a strategy to make sure that your minimums are paid within 30 days of the due date. Let me just try to explain this as easy as I can. If you have a credit card and it's $1,000 credit limit, and let's just say that you buy something and you owe $750. You're at $750 out of $1,000 in usage, which is 75%. If you get it below 50%, your score will go up. Here's another tip for people that are trying to build credit: get added as an authorized user on a family member's credit card. Because, okay, so you're at 75% at $750 out of that 1,000. Let's just say that your dad has a credit card that has a $5,000 credit limit, and he only owes like $100 on it. He could add you as an authorized user, and now instead of being 75% of that $1,000 credit limit, your credit limit is now $6,000, and you only owe $850.
Wow, I didn't know. Well, I knew that there was something in that because when I was first opening my bank account, going through everything, I was going through school and all that kind of stuff. It was time for me to have a bank account. I wanted to apply for a credit card, and this was about 2 years into college. I literally did not have a bank account until 2 years into college. So initially, when we had to take out all of the loans, I had to do that with my dad because I had no record whatsoever. So me and my dad get put on these loans, both government and personal. Some government loans were able to be, I got, scholarships or whatever. And then some of the loans we had to go through like Citizens Bank, but both of our names were on it. And then when it came time to apply for a credit card, the manager that was opening my account had asked me, do you want to open a credit card? And I said, I do, but I don't have any records or history or whatever. And she said, oh, well, we'll pull it anyway because you'd be surprised. And to my shock, at that point, I had a 720 credit score without ever owning a credit card because I was with my dad's name on those loans for school. And I was just like, my mind was blown at that point because I had a record without even having a record.
So just real quick of what you're saying about when you went to that bank, and let's just say you weren't on those loans and you had nothing to establish credit. Banks in particular, they have what's called a secured credit card, and it's to build credit. So for those that are looking to build credit, a secure credit card is you take your own money and you preload it into a card that's by the bank. Let's just say $500. You take $500 and you go to Wells Fargo and you say, I want to open a secure credit card. You take that $500 and you put it into a card. Now you have a $500 credit card limit, and then you go and pay something. You go fill your tank with gas, and then you pay it or pay on time for the next 3 months. All of a sudden, you've established that you can repay stuff on time, and you'll get offers for more credit cards.
I do remember in that moment when I said, I don't think I have any history. She said, well, let's run you for a check for a regular credit card. And if that fails, she mentioned another option. I'm pretty sure that's what that was.
It's 100%. It was a secure credit card, because they're at no risk if you're loading your own money into the card, but it's a credit builder. There's a million reasons that people would want to build their credit for different times. Worst case scenario, you go through bankruptcy. With bankruptcy, they all of your accounts are gone, and you have to reestablish credit. People get a secure credit card or multiple secure credit cards to reestablish credit, because they have to reestablish that they're going to be able to pay their monthly bills, pay their bills that are on their liabilities that they're borrowing money from.
That's really interesting. And I wanted to circle back to when you mentioned don't ever cancel a credit card. Why?
Because Okay, so back to what I said about you owe $750 of that $1,000 credit card. Let's just say that you pay off that $750. You have $1,000 available credit, and then you take out another card for, we'll say like an LL Bean card, $500 credit limit, and you buy clothing, $300. So they look at it as you have a $500 credit card and a $1,000 credit card. So you have $1,500 of credit limit, and you only owe $300. You can't cancel that $1,000 card. All of a sudden, you're at 60% credit utilization because you only have $500 available credit left.
I understand. So this is more like if you have a balance, a significant balance on a card, and you have other cards open, it's helping distribute that percentage that you were talking about.
They're taking the cumulative. They're adding up all of your available credit and then credit usage.
Very cool. Well, thank you so much for sharing that with us. Now, as far as good practices, good financial hygiene, for lack of a better term, for people that are looking to get pre-approved for a mortgage, what are some good practices that you would recommend to us?
Well, so I was a big Mint person. Mint.com was owned by Intuit, which is an accounting software where you could put in your monthly bills and you could keep track of payments, bills, all that other stuff. Intuit got bought by Credit Karma. I have never been a fan of Credit Karma, but Credit Karma is a useful tool when it comes to keeping track of your accounts, keeping track of your due dates, keeping track of your balances, because it can refresh daily. Your credit score is not accurate on Credit Karma. I can't reiterate that enough, because Credit Karma, their credit rating starts the day you open your Credit Karma account. It does not do historical data.
Okay.
Does that make sense?
Yes, that does.
But it is a very useful tool, and I suggest everybody has it now that they bought into it. And you can do some useful things as far as learning to balance your budgets with their software. You can keep track of all of your accounts through there, and if there's any new charges, if you accidentally sign up for a little subscription that you get charged crazy amount, like these, there's a trillion different little subscription things that if you don't unsubscribe, they keep recurring. But and if you don't go on all your stuff all the time, on all the different websites, you wouldn't know. But that's a centralized place that you can go, if that makes sense.
That's awesome. Yeah, and I can't recommend that enough, because in one episode I did talk about how I kind of went through and overhauled all of my subscriptions. Like after I hit year 2 in business, I went through all of my subscriptions and I was astonished by how many I had that I wasn't even using. I saved myself about $60 a month when it was all said and done.
Right, 100%. It's just wasted money if you're not fully aware of everything.
Exactly. And I think software like that can kind of pull it all into one place is so beneficial.
Right. No, it is, because I say this just because over the years and over the different evolutions of digital everything, online everything, I have a live Excel spreadsheet where I keep all of my logins, all of my passwords, and then a separate link with the link for what the login site is, alphabetized. It's crazy how many times you use that, and then how many new sites you have to log into along the way. That's just something I use. But one that auto updates every time you change it, because you have to change your password every now and then too.
For sure, absolutely. I use a password manager. I use Bitwarden is my password manager. It just attaches right to the browser, and I can't live life without it. But that was such a good thing for me, because every single time I would create a new username and login, it would say, do you want to save it to Bitwarden? And I would always say yes. And then when it came time for me to sit down and be like, all right, I got to get serious about this. I got to go through all my shit. And I looked through my Bitwarden and I just went item by item by item. And I was just like, my God, I think I had 300.
Before you know it, it becomes overwhelming. And there's
really
no
does.
way. And so many of the places now have different requirements on the passwords. So you can't use the same exact password on all of them. So to try to remember every different password, I mean, you need something as a reference guide. To try to remember it is impossible over time.
Absolutely. Very cool. I know you mentioned in your thing specifically you wanted to talk about lending in 2025. So let's talk lending in 2025.
When people hear about the Fed doing rate cuts, I need everyone to understand that's not mortgage cuts. The Fed fund rate is what's based on credit cards, auto loans, home equity lines of credit. Mortgages are based on the bonds that are traded on the stock market. Yes, we do get some relief when there is a quote unquote Fed fund rate cut, but like on September 15th, when they cut the rates 0.25%, our rates dropped for about 3 hours and then went up until like this week. They were higher than they were all year since September 15th until this week. This week we've gotten some relief because the stock market is crashing everywhere. Essentially, I would try to explain this to people. Rates only drop when your 401k drops. If everyone's doing great on their 401k, interest rates are going to be high. People want both, but low rates and booming stocks are like, I mean, they work opposite.
I noticed that too because I have a high interest savings account. This is something I just started. I knew I wanted to start it early on in my business. And the problem is you want the low rates for the mortgage, but that means a low rate for your savings account. And then when the savings account goes up, which is phenomenal, and you're like, yeah, awesome, I'm getting more, then the interest rates go up for the mortgages as well. So I know exactly what you're talking about because my excitement when I saw my interest savings account going up and up and up was quickly dampened by the mortgage rates going up and up and up.
It's true. The statistical data, I mean, it's accurate. Don't let anybody tell you it's not accurate. Inflation was caused by numbers. Inflation was caused by excess money being put into the market where people could buy more things, and it was a supply and demand thing of like when the stimulus checks and the extra $600 in unemployment when people got laid off every week, people bought up a lot of stuff, and that led to low supply, high demand. That led to inflation. That wasn't people's choices to do inflation. That was how the numbers played out. It had to slow everything down, and I mean it has. And like I said about the rates being in the 2s and 3s, that was great for the people that were able to refinance into the like those really low rates, but they're not moving because they have those really low rates, and that hurts the housing market, which makes less houses available, which makes demand for the lesser houses available super high. I would tell you that I know what's going to happen in 2026, 2027, 2028, but I'd be lying. The only thing I can tell you, because we don't know what's going to happen one day to the next these days, and it's really hard on the financial planning side because we don't know. Honestly, we don't know what the hell's going to happen. We don't know.
And that's the thing, too, is things can change. Bills can be passed, acts can be passed, and you don't really know how things are going to change and shift depending on what type of legislation is going through and all that kind of stuff.
It truly is unpredictable right now. But all I can say is that everyone can take it from a personal side of getting yourself into the best debt to income position that you can get. Try to lower your debts that are on your credit report, consolidate to the lowest interest rates that you can get. So on paper you look maybe better than you really are, but on paper you look good.
Exactly. And then talk to me just a little bit about how anybody out there that is running a business, maybe does have some outstanding debt and owns a home, how they can leverage that as a tool.
Timing is paramount in all of this because those that bought prior to 2020, you probably have equity that you didn't even earn. I mean, housing prices just went up, values went up without even improving a house. But that's unrealized benefit to you unless you sell the house or you use that money in a refinance to pay off other debt. That money doesn't have a tangible value unless you use it. I mean, just hypothetically, let's just say you have 30,000 in student loans and credit card debt that is costing you $700 a month, $800 a month, and you have 100,000 in equity in your property. You can't pay off that 30,000 unless you refinance or do a home equity line of credit, which will only go to 80% of whatever your home is valued at. Every situation is going to be different, and I would say that it's a more one-to-one conversation on everyone's situation. But if you own a home and you do have equity and you do also have other debt that you just can't pay off, it's worth a conversation. Should try to get you into your best opportunity with the quote-unquote assets that you have. And again, unless you sell the house and you get that equity, or that equity is just sitting there and it doesn't really do anything for you in real life, just on paper. But if you paid off that $30,000 in a refinance, and then that extra $700 or so that you were paying adds $112 to your mortgage, you've just made $600 a month. One other just quick mention, anyone that has elderly relatives that own a home, maybe by themselves, and maybe are on a Social Security fixed income or something like that. We've come across a lot of struggling elderly people trying to make their mortgages. There's what's called a reverse mortgage for anyone that's 62 and a half and older that has a lot of equity and 50% equity in their house, where it's only for those people. It's called a reverse mortgage, where the equity in their house can pay their mortgage, and they don't ever have to make a mortgage payment ever again. I just helped out a few people this year. She's 85, she's a Spitfire, but she had to pay $1,300 a month, but her Social Security was only $1,700. She had $150,000 in equity, but she wasn't selling her house. We did a reverse mortgage. She no longer has to make that mortgage payment, and she lives in her house.
That's
and she
incredible. And it's probably feels so good to help out the older generation too. I mean, for the people that they really don't know any better, most of us don't. I think it blows my mind how little knowledge we were given about mortgages. I got to learn to do algebra and calculus and geometry and trigonometry and all this stuff, but mortgages and finance and all this stuff is just not at all. Like, we didn't even learn how to make out a check in school. Nothing. So to be able to help that elderly generation, I feel like that's just really wholesome work.
To your point, I learned this business, and when I first started, the mindset of helping people wasn't anyone's mindset. And I saw it evolve. I fear that it's going away, but I saw it evolve into that. And that's what kept me in the business too. But a year ago in December, I helped a couple that they had old collections. They got laid off in 2020 and 2021 for COVID, and they had a bunch of old collections. Their credit score really took a hit. They had a 515 credit score. They had been stuck because they had these old collections, and they had a private mortgage. They couldn't get a regular mortgage, so their landlord gave them a mortgage. They had so much equity in the property. I helped them pay off all their debt and their private mortgage and get $40,000 out of their property. Their property appraised for $275,000. They only owed a total of $90. 7 months later, they had a 700 credit score. They had no debts delinquent on their account, and their whole lives were better.
That is so incredible. I love, honestly, any business owner out there that is genuinely just trying to help people. I feel like it's amazing, because that's what I do. I'm not out here to make money. I mean, obviously you have to make money to pay bills, but that's not why I'm doing what I'm doing. If money didn't exist, I would still be doing what I'm doing.
For sure.
Because I'm helping people feel more confident in their branding and visual identities and all that kind of stuff. And to hear you're kind of giving that confidence back to people like that is it's so incredible.
It's one of those things, it doesn't feel like a job.
Yep, exactly. If you love what you do, you never work a day in your life. And it's cool to hear that you kind of accidentally fell into the mortgage world, because I know you briefly told me a little bit about your work history before that, and it was different. There was some overlap, but definitely different. And to hear that you kind of accidentally fell into it, but you always had this love of numbers, and you know, you're really good at numbers. You're the numbers guy. I mean, when I talked to Dan about having you on the podcast, the first thing that he said is, "Oh man, you're going to love him. He's a numbers guy." So it's really cool to hear your perspective, to hear a little bit more about numbers, because I think this is something, you know, in the creative industry, I don't hear much about. There's a ton of other design podcasts out there, and a lot of other designers just bring on other designers. But the problem is, like, designers know what a designer's life looks like. Designers don't know what junk removal guys do. Designers don't know what it's like to deal with lending and try to buy a house. Designers don't know about accounting. And I've really made it my mission to kind of bring on these people. Like, I've had an accountant, I've had Dan on with the junk removal side and
You
partial
don't know
graphic
you
design.
need Dan until you meet Dan. Then you know you need him.
Yeah, no, Dan is literally so great. We love Dan. But yeah, Jim, thank you so much for being willing to be on the show. To anybody out there listening, if you have any questions about lending, if you have, you know, any questions about credit or anything, Jim will be your go-to guy. Feel free to reach out to him. Would you like to tell everybody where they can find you online and where they can best reach you?
My name is Jim Gillespie, and domain name jimgillespie1.com, and that takes you right to my online application. My cell phone is, I've had the same cell phone since 2002. I feel like a million people have it. I've used it for work, for everything. 610-972-5546. Anyone can call me or text me, and I can do my best to help them out.
Awesome. Well, thank you so much for your time on the show today, Jim.
I really
Everybody
appreciate it.
listening.
Thank you, Jen.
Yeah, no problem. To everybody listening, don't hesitate to reach out to him with any questions. And I will see everybody in next week's episode. Bye.